All right, welcome back to another valuation lecture. And this time we are going to focus on the private income valuation. In our last session, we focused explicitly on the residual income valuation, and today we are going to extend into another branch of the vast valuation practices, which is the private income valuation. So, we are going to explore the unique characteristics of private companies and understand how these attributes influence their valuation. So, private companies, they are incredibly diverse. They range from small single employee ventures to large multinational enterprises. So, this diversity itself necessitates a variety of valuation practices tailored to each type of business, and that is going to be our starting point for today's lecture. So, the diversity of private companies. Private companies span a wide spectrum, as we just spoke about. So, on one end, we have small unincorporated businesses operated by a single individual or a family, and these are often local businesses, such as a family owned bakery or a local consultancy firm, and or it could be a restaurant by family owned restaurant, things like that. And on the other hand, we find large corporations that were once publicly traded but have been taken private through management buyouts or other type of transactions. These could include firms that have significant market presence and operational complexity. For example, consider a small tech startup with maybe 5 to 10 employees focusing on developing innovative software solutions. Now, contrast this with Dell Technologies, which was a public company once before being taken private by its founder Michael Dell in one of largest leverage buyouts in the uh, corporate finance history. So you can see how vast and broad the spectrum of private companies be, and based on this, the different valuation practices that could be incorporated into private income valuation. And then, since this large spectrum involved with large scale private firms, let's see why they have remained private and what their business practices and operations are. So, IKEA. IKEA, I'm sure all of you have heard about. It is a Swedish furniture giant, which is a household name worldwide, known for its flat pack furniture and innovative store designs. So, IKEA has remained private, and its private status had allowed them to reinvest profits into expansion and sustainability initiatives without the scrutiny of public markets. So, why most of these firms have remained private is there are a lot of advantages when you go public, but alas, at the same time, your entire business practices and operations get exposed into the entire public, their eye, their scrutinization. So the same goes for Bosch as well. It is a leading global supplier of technology and services, and they operate in various sectors, including automotive, industrial technology, and consumer goods, and even in finance as well. So you can see how they are a large conglomerate. Their private status facilitates substantial investment into research and development, fostering their innovation, which is a key factor in their success story. And then Cargill, not the Cargills in Sri Lanka, the Cargill conglomerate in the United States. It is again one of the largest privately held companies in the domain of United States. They also operate in agricultural, food, industrial, and financial sectors. So being private enable Cargill to pursue a long-term strategy focused on sustainable growth and innovation. And Bechtel, it is a major player in construction and civil engineering. They handle large-scale infrastructure projects in a global scale, and they have also remained private, and their private ownership supports a focus on complex long-term projects without the immediate pressure of public shareholders. So when public shareholders are associated in a company, you have to reveal your income, you have to reveal your practices, you have to reveal your operations, you have to provide status reports. Every one of these things are a crucial thing when you go public, but you can avoid this entire burden by remaining private, which is why a lot of these large scale firms have taken that decision to remain in private. So, these diverse characteristics that we have just spoken about, on one side, we have the large and broad spectrum of private companies ranging from a small scale to significantly large scale. And even in these large scale businesses, you can see they vary across multiple industries. So you can see how diverse characteristics are being associated into these private companies. So, this unique characteristic feature of private companies necessitate diverse valuation methods. So, unlike public companies, private firms do not have readily available market prices for their shares. This lack of market data requires analysts to use alternative approaches. So, common valuation methods which are being used are income approach, market approach, and asset-based approach. So, income approach is the method where it is used to value a company based on its ability to generate future earnings or cash flows. So this often involves discounting projected cash flows to their present value using a discount rate that reflects the risk profile of the company, which is kind of similar to the discounted cash flow you are familiar about. And then we have the market approach. This involves comparing the company to similar businesses that have been sold recently or are publicly traded. The key is finding comparable companies in terms of size, industry, and financial health. And then finally, we have the asset based approach. This method calculates the net asset value by subtracting liabilities from assets. And this is particularly useful for intensive businesses such as manufacturing firms or real estate firms. So let's take an example of a small retail business. So if we focus on this, which is again, we are going to assume that it is being operated in private sense, an income approach might involve projecting future sales and expenses to estimate future cash flows, which are then discounted to the present value. For a large private manufacturing firm, an asset-based approach might be the more appropriate method because it focuses on the value of the physical assets and machinery. Now, private and public company valuation, the similarities and contrasts. Here we are going to delve into the distinguishing factors between private and public company valuation, and these differences can be categorized into two main areas: company specific factors and stock specific factors, each impacting the valuation process in unique way. So, when comparing the valuation of private and public companies, it is essential to recognize that the characteristics distinguishing these entities can be categorized into these areas that we have just identified. And let's dive into what each of these factors are. So, we are going to start off with the company specific factors. These factors pertain to the internal dynamics and characteristics of the company itself, so influencing its valuation irrespective of the stock market. And we are going to start off with the stage in life cycle. So companies can be in various stages in their life cycle. They could be startups, growth, they are rapidly growth stage. They could be a mature firm or they could be in a declining stage. So each stage presents a different risk profile and growth potential. For example, a startup tech company in its early stages may show high growth potential but is again also high risk. Conversely, a mature company, for example, let's take Procter& and Gamble, is likely to exhibit stable earnings and lower growth but again at the same time lower risk. Then the size of the company. The size, often measured by revenue, market share, or number of employees, significantly affects its valuation. Larger companies generally benefit from economies of scale, leading to potentially higher profitability and lower per unit costs. For example, let's take Walmart, one of the retail giants in the entire world. Their retail chain has a different valuation approach compared to a small local boutique due to its extensive market reach and operational efficiency. Again, example explain itself out. And then we have the overlap of shareholders and management. So in private companies, there is often significant overlap between shareholders and management, which I just spoke about when we were discussing about the real life private companies. So this can streamline decision making, but also introduce potential conflicts of interest. So for example, if we consider a family-owned business where family members are both major shareholders and managers, this setup can lead to unified vision and strategies, but again at the same time might also result in decisions that favor family interest over the external shareholders. Then we have the quality and the depth of management. The experience and expertise of the management team play a crucial role in a company's success, which is quite obvious. So, a strong, experienced management can drive growth and innovation, whereas weak management can hinder progress. For example, let's take a prominent chief executive officer like Elon Musk at Tesla, they can significantly influence investor confidence and the company's valuation, which we have all seen in the past couple of years, particularly after the pandemic. You can all read about it. It is all over the internet. And then we have the quality of financial and other information. Public companies are again required to provide regular, transparent financial disclosures, but on the contrary, private companies may have less stringent reporting standards, leading to potential information asymmetry. So, if you take a public company like Apple or Nvidia, they provide quarterly earnings reports and audited financial statements, while private companies might need extensive due diligence to assess their financial health in an accurate manner. Then you have the pressure from short-term investors. So public companies often face pressure from investors to deliver short-term results, which can influence management decisions. But private companies, they might have more freedom to focus on long-term goals because when public shareholders are involved, their benefit, their advantage need to be prioritized because they are the actual people who have invested money in the company in a significant sense. But private companies, their pool of wealth coming from a limited number of resources, so they can particularly focus on their long-term goals. For example, if we take a public company like Amazon, they need to meet quarterly earnings expectations. But while private companies, for example, SpaceX, they can pursue long-term research and development without the immediate shareholder pressure. And then everyone's favorite, whether you are public or private, tax concerns. So tax strategies again can differ significantly between private and public companies, impacting net income and cash flows. Private companies might employ aggressive tax strategies to optimize their liabilities because of their limited exposure in attracting funds to their organization. So they may engage in tax planning strategies that reduce taxable income, while public companies need to balance tax optimization with regulatory compliance and public scrutiny. So with those company specific factors, now let's jump into the stock specific factors. So these are related to the characteristics of the company's equity, impacting the liquidity and transferability of shares. First, we have the liquidity of equity interest in business. So public company shares are more liquid due to being traded on stock exchanges, allowing easy buying and selling. But private companies, they lack this liquidity, making them harder to trade. Investors can easily trade shares of maybe a company like Microsoft on the stock market, providing high liquidity to the company, whereas shares in private firm like Cargill are not publicly traded and hence less liquid. Then the concentration of control. So private companies often have concentrated ownership, which can lead to significant control by a few individuals or entities. In contrast, public companies usually have dispersed ownership among many shareholders. A private equity firm owning a substantial stake in a private company has considerable influence of its strategic direction, unlike a public company, where control is more distributed among numerous shareholders. And finally, we have potential agreements restricting liquidity. Private companies may have shareholder agreements that restrict the transferability of shares, impacting liquidity and valuation. So, if we take an example here, a family business might have agreements that prevent family members from selling their shares to outsiders, limiting liquidity and affecting the overall valuation. So, we see this a lot of times, particularly in private firms which have started their operations, they have come to a prominent stage, but from that point onwards, a lot of private companies would not reach their optimal potential market share wise because these certain practices the family oriented private companies tend to have. All right, so now we are going to drive into reasons for performing valuations, particularly with the sense of private entities. So, understanding the reasons behind performing valuations in private entities is crucial as it guides the approach and methodologies which will be used in the overall valuation approach. So, they are conducted for various purposes, which is again highlighted in public company valuations as well. So they are here categorized into three main areas: transaction related, compliance related, and litigation related. First, we have transaction related, and here we are going to discuss private financing first. So, this is when a company seeks to raise capital from private investors. So, here evaluation is going to be necessary to determine the price at which shares will be sold. So, As an example, we can say a startup raising venture capital funding will need evaluation to set the equity stake that investors will receive in exchange for their investment. Then we have the IPO or the initial public offering. So before a company goes public, it again needs to be evaluated to set the initial share price for the IPO. So, for example, a company like Uber prepared for its IPO, extensive valuation exercises were conducted to determine the offering price for its shares. Actually, uh, Professor Ashwath Damodaran, which I had followed to make these lectures in the first place, he conducted Uber's valuation in one of his sessions and he actually participated in the actual Uber valuation. So you can take some time, maybe even after the exam, to search how Uber's valuation was conducted and how they have come into its final agreed share price before it was going to go public. And then we have acquisition. So you already know what acquisition is. So in mergers and acquisitions, valuation are crucial to determine the fair price to be paid for the target company. So when Facebook acquired WhatsApp, a thorough valuation of WhatsApp was necessary to agree on the purchase price, which is another great valuation success story. And then we have bankruptcy. During bankruptcy proceedings, a valuation is again needed to assess the company's assets and determine how much creditors and shareholders are going to receive. So when Lehman Brothers were bankrupted in the 2008 financial crisis, valuation of its remaining assets were essential to distribute the process to creditors. And then you have the share-based compensation. Companies often use share-based compensation to incentivize employees. So here also valuations are needed to determine the fair value of these shares. For example, a tech startup granting stock options to its employees needs to value these options to ensure that they are reported correctly in financial statements. I'm sure all of you would have known about the Samsung debacle, where they have provided these kind of stock options and an incorrect assessment was made, and more than millions of value was increased in the stock options which were incurred by the Samsung employees. And I believe within 15 or 20 minutes, they all have cashed out, and the company's valuation took a significant hit, or rather, their share price took a significant hit. So, again, another story which educates us the importance and the imperativeness of maintaining proper valuation practices. And here it is perfectly explained under the share-based compensation under the transaction-related reasons. Then we have compliance-related reasons. So they are required to meet regulatory and reporting requirements. And here we have two key ones: financial reporting and taxes. I think those are self-explanatory. And then you have litigation-related reasons. First, we have shareholder disputes. So, valuations are necessary to resolve disputes between shareholders, especially in cases of buyouts or dissolutions. So, for example, if we take a family business where a shareholder wants to exit, a valuation determines the buyout price for the departing shareholder's stake. And then we have damage claims. In litigation involving financial damages, valuations would help quantify the monetary loss suffered. So, if we take an example of a company suing for breach of contract, they may need evaluation to support its claim for lost profits due to this breach. And this would be a perfect segue into the third point, which is the lost profits. So, under the lost profits, valuations are used to calculate them in cases where a business has been adversely affected by external actions. So, if we take when a business disrupted by a supplier's failure to deliver key components or key materials, this would need evaluation to estimate the lost profits which was incurred as a result of the supplier's action. And divorces. In divorce proceedings, valuations are necessary to equitably divide marital assets, including business interest. So, if we take an example of a private entity owned by one spouse, will need to be valued to determine its worth and ensure a fair division of assets in the divorce settlement. So you can see under all three areas, transactions, compliance, and litigation, how private entities would need to perform valuation under different scenarios, under different circumstances, and how each of them are perfectly reasonable and the additional value it would generate under each of these circumstances. Then we come into the definitions or the standards of value. So, understanding the different standards of value is crucial in the business valuation, particularly in private income valuation, because each serves a specific purpose and context. So let's dive and delve into each one of these standards of value. First, we have the fair market value. Fair market value is the price at which an asset would change hands between a willing and able seller and a willing and able buyer in an arm's length transaction. The keyword being arm's length transaction. So, here, with neither party being under any compulsion to act and both having reasonable knowledge of relevant facts is highlighted. So, this is often used for tax purposes and in transactions involving the sale of a business or its assets. Then we have the fair value for financial reporting. First, we had the fair market value. Now we have the fair value for financial reporting. So, fair value for financial reporting purposes is similar to fair market value, but is specifically defined under accounting standards such as IFRS and US GAAP. It represents the current price at which an asset can be bought or a liability can be settled. So this is used in preparing financial statements and for purposes such as impairments, purchase price allocations, and fair value measurements. So for example, when a company acquires another company, the acquired assets and liabilities are recorded at their fair value as per financial reporting standards. And then we come into fair value for litigation. Fair value in litigation context is used to determine the value of assets or liabilities as part of a legal dispute. The definition can vary depending on US state status and legal precedents, but the ideology is going to be remain the same. So this standard is applied in cases such as shareholder disputes, divorce settlements, or damage claims, which we have just discussed earlier as reasons to perform valuation. So let's take an example where a shareholder dispute, where a minority shareholder is being bought out, fair value might be used to determine the compensation owed to the departing shareholder. And then we have the market value. Market value is frequently used for appraisals of real estate and other tangible assets in private entities. Not only private entities, but in this context, private entities, especially where the purchase will be leveraged. It reflects the price at which an asset would trade in a competitive auction setting. So this is commonly used in real estate transaction and appraisals as well as for secured lending purposes. And then you have the investment value. Investment value refers to the value of an asset to a specific buyer based on their particular requirement and expectations. So, this standard considers factors such as expected future cash flows, perceived risk, discount rates, financing costs, and potential synergies with existing assets. This is essentially crucial in private company valuations and acquisitions, where strategic buyers may have different valuations based on their individual circumstances. So, for example, a private equity firm valuing a manufacturing company may have a different investment value compared to a strategic buyer who sees potential synergies with their existing operations. And then finally, you have the interesting value. I'm sure you will be asked to evaluate the interesting value of certain entities in your final exam paper. So you need to have a good idea on what actually is the intrinsic value. So intrinsic value is derived from fundamental analysis and represents the true value of an asset based on its inherent characteristics independent of the market price. So the key phrase is going to be it represents the true value of an asset. All right, true value of an asset. So this is often described as the value any other investor would arrive at through comprehensive analysis. So this is essentially used by investors and analysts to determine whether an asset is undervalued or overvalued based on its intrinsic worth. So, for example, an investor evaluating the intrinsic value of, let's say, a company like Apple or Microsoft, they would consider factors like its future earning potential, growth prospects, and competitive position rather than just its stock price. So, now we have a fair and clear idea about all these different types of values are and what they are going to matter in the domain of private entities. And then finally, we come into the private company valuation approaches. So, here I'm going to introduce various methods and considerations involved in valuing private companies, and each approach would address different aspects of a company's financial health and market position, providing a comprehensive framework for valuation. And we are going to start off with earnings normalization and cash flow estimation issues. Earning normalization is going to involve adjusting a company's earnings to remove the effects of non recurring items, unusual expenses, or revenues that do not reflect the company's ongoing operations. This provides a clearer picture of a company's true earning potential. So, here, the key word being we are going to normalize the non-recurring items, unusual expenses, and certain earnings which actually would not reflect the current operations of an entity. So remember these key aspects of the earnings normalization approach. And then we come into the income approach methods of private company. So the income approach values a company based on its ability to generate future income. So this method often involves discounting future cash flows to their present value, which is what we have been used to so far. Then we have the market approach method for private company. So market approach determines the company's value by comparing it to similar companies that have been sold recently or are publicly traded. So here we are going to adopt the comparable company analysis, or in the acronym CCA. So compare valuation multiples of similar public companies is what you are going to do when you are going to adopt market approach methods for private company valuation. And then we have the asset-based approach, which is also similar to the standard asset-based approach we are used to in public companies. So this one would value a company based on the fair market value of its assets minus its liabilities. So this is often used for companies with significantly tangible assets. So this kind of an evaluation could be predominantly useful, let's say a manufacturing or a technology firm with a considerable amount of assets. Then asset-based approach is the most suitable method for them. And then you have the valuation discounts and premiums. Valuation discounts and premiums are adjustments made to reflect specific attributes of the company, such as lack of marketability or control. So the key aspects of valuation discounts and premiums are, first one is going to be the discount for lack of marketability, which is used in the acronym DLOM. So here you need to adjust the value to account for the difficulty in selling shares of a private company. Then you have the control premium. So here you are going to apply a premium if the valuation involves a controlling interest in the company. So for example, a minority stake in a private company might be discounted due to the lack of control and marketability compared to a controlling stake. And then finally, you have the business valuation standards and practices. So, adhering to established standards and practices ensures that valuations are conducted consistently and accurately. So, these standards are set by professional bodies to guide the valuation process. So, here the key factors to remember is, the first one is Uniform Standards of Professional Appraisal Practice, or USPAP. This is going to provide guidelines for ethical and performance standards in the valuation that you are going to conduct for the private company. And then you have the International Valuation Standards, IVS. This offers a global framework for valuation practices particular to the private entities. So, for example, valuation professionals would adhere to either IVS or USPAP to ensure their valuations are reliable and comparable across different contexts and jurisdictions. All right. So, now I think you have a clear idea about the different valuation approaches that could be adopted uh, under the private company valuation procedures. And now we come into the earning normalization and cash flow estimation issues. So we are going to first focus on the actual definition and the purpose of having normalized earnings in the first place. So earlier we actually pointed out what earning normalization is going to be. It is going to be associated with altering or adjusting the company's earnings to remove the effects of non-recurring items and those unusual expense and that overall aspect that we have just discussed about. But let's try to have a common definition and a more clearer purpose. So what are normalized earnings? Normalized earnings are economic benefits adjusted to remove non-recurring, non-economic, or unusual items and thereby facilitating better comparisons and providing a clearer picture of a company's sustainable earnings. So, for example, adjustments might include removing one-time legal settlements, restructuring charges, which is again going to incur if you are restructuring your firm's overall operations, or extraordinary gains or losses from the earnings. For example, if you experience a significant blow to your company's earnings with the burn down of a factory outlet or a plant, which is not going to occur again, soon or which is not going to occur in a recurring manner, right? It is most likely going to be a one-time thing, and those type of impact to their earnings needs to be normalized before moving on with the valuation. And then you have the impact of a related party transaction. So here you are going to be associated with inflated or deflated expenses. So what are these? When a closely controlled firm does business with its owners or other businesses controlled by its owners, reporting earnings may not reflect the true economic reality. For example, expenses might be inflated if the firm overpays for services from a related party. But on the other hand, or conversely, if owners receive compensation below market levels, the earnings might be artificially high as the undercompensation is not reflected in expenses. And then we finally come into the real estate aspect and how earning normalization is associated in the terms of real estate, which is mostly going to be privately held entities. So, under this, we are going to focus on the separate real estate operations. So, real estate owned by the firm often requires separate treatment due to its distinct risk characteristics and growth prospects compared to the firm's cooperation. And additionally, real estate is usually reported as a depreciated expense based on historical cost, which may understate its current market value. So, what is the reason for this separate treatment? Different risk characteristics, as we have just discussed, because real estate might have lower volatility compared to the firm's primary business. And growth prospects, again, they can appreciate independently of the firm's operational performance because real estate is a market which is not really going to depreciate unless an extraordinary thing happen. For example, the 2008 financial crisis, where the mortgage market of the US was shattered down, but it is not going to happen anytime soon, or we can certainly hope so. So that is going to be again going to be usually appreciated. And then finally, we come into the accounting depreciation, which may not accurately reflect the current market value when it comes to real estate, necessitating adjustments, which is again going to tie back into the earnings normalization. And then we come into uh, an actual scenario, and let's see how this is going to play out. So here, this says that Tim Grow is the principal shareholder and CEO of Arbutus Generators, and they have report the following values. Tim Grow, or the CEO's compensation, is 2.5 million, and it is included in firm's general and administrative expenses. And the Arbutus leases a warehouse for $100,000 a year from one of its largest suppliers. The company or the Arbutus owns a vacant office building with general administrative expenses of 150,000 and 250,000 of sorry 25,000 of depreciation. And then it says that the company's capital structure has too little leverage. So, analyst adjustments, the analyst for this firm had made the following adjustments, saying that the market-based compensation for CEO or the team growth person is $1 million. Therefore, the excess 1.5 million should be removed from the general expenses to normalize the earnings. And when it comes to warehouse lease, the lease expense of $100,000 should be examined to ensure it reflects the market rates. And if the lease is above market rates, the excess amount should be removed from expenses. And then the vacant office. Since the office building is not used for corporations, its expenses, which are the 150,000 general admin expense and the 25,000 of depreciation, they should be excluded from the operational earnings. And the market rental rate for the vacant office space, $130,000, can be considered an adjustment if the building is to be leased out. And then you have the capital structure. Uh, Capital structure, it says that the current capital structure is noted down by the analyst, and any adjustments here would typically involve change the interest expense if leverage is increased. So the question asks us, based on the above, what adjustment should the analyst make to the arbitrator's reported income to estimate the normalized earnings, assuming the firm is going to be acquired? So let's take a moment to note this down and actually solve this scenario. All right, let's start off with the CEO's compensation. Tim Grow. The excess compensation is going to be 2.5 minus 1 million. This is going to be 1.5 million. And then you have the office building. Office building adjustment. It is going to be 150,000 plus 25,000 because of the general admin expense of 150,000 for the lease, and the depreciation of 25,000 is going to be 175,000. And here we are going to make the normalized earning adjustment as follows. Normalize earning adjustments. So let's assume that the original expense is X amount. Originally is $X, and then we are going to make the adjusted SG&A, general admin expense. It is going to be X dollars minus 1.5 minus, sorry, here it's going to be a plus because I'm using brackets. It's going to be 0.75, I think. So 1.5 million plus 0.75, and the total amount is going to be, total adjustment is going to be the sum of these two. This 1.675 million to the SG&A expense. SG&A expense. So by making these adjustments, the analyst would ensure that the normalized earnings of Arbutus generators reflect a more accurate representation of its ongoing earning potential, removing distortions caused by non-recurring, non-operational, non-market-based transaction. So what we have understood in this entire process is earning normalization is a crucial step in the valuation process, ensuring that the company's reported earnings would reflect its true economic performance. So by adjusting for these non-recurring items related to party transactions and non-operational assets like real estate, analysts can provide a clearer and more accurate picture of the company's financial health. So this overall process that we have spoke about step by step is going to be essential for making informed investment decisions and conducting fair valuations. All right, let me remove these. I will erase these parts. All right. And then I have included something for you to research on your own, strategic and non-strategic bias. But again, I'm not really going to focus on this because we will anyway cover more of these buying and acquisition aspect when it comes to the mergers and acquisition lecture. But in your free time, please feel free to research more on this. And then we come into the cash flow estimation issues for private companies. Because of its unique nature in private entities, they often come into certain challenges due to uncertainties in future cash flows and influence of the current owner's input. So here we are going to explore these challenges, and it is going to provide guidance on how to approach cash flow estimation for private entities. And we are going to start off with calculating the free cash flow. So free cash flow to the firm, or we acronym it as FCFF, or equity holders FCFE, is a crucial measure for valuation, but it can be particularly challenging to calculate for private firms due to uncertain future cash flows. The figures are often generated using the current owner's input, which can introduce bias or reflect overly optimistic assumptions. So this can usually happen because if the owner is going to conduct the valuation with their input, what's to say they are not going to bubble up their currently existing values, right? What is the guarantee? So that is one big problem. So then following that, we have the scenario analysis. So given significant uncertainty about a private company's future operations, analysts should examine several scenarios when estimating future cash flows. So they need to identify certain scenarios associated with private firms, and for each scenario, they need to estimate cash flows and assign a discount rate and probability based on the scenario's risk and likelihood of occurring. So to calculate a firm value for each scenario and use a weighted average of these values to estimate the overall firm value is the approach they should be taking. And then you have the discounting cash flows itself. So here for private entities, you would need to use a weighted average scenario cash flow, which can be discounted using a single discount rate to arrive at an estimate of the firm's value. So this would actually simplify the calculations, but still accounts for varying future outcomes. So then you have the choice of using FCFF versus FCFE. So FCFF, that is the free cash flow to the firm, and then you have FCFE, which is the free cash flow to the equity shareholders. They can be used depending on the valuation's purpose. So you need to determine which approach to be adopted because FCFF is often more appropriate when significant changes in the firm's capital structure are anticipated. So it would actually provide a clearer picture of the firm's value before considering the effects of the financing decisions. All right, now we have an example. So Abel's debt is 2 million, and they are going to use the FCFF approach to valuable, and the relevant data is presented. Long-term growth of revenues and after-tax operating income is 3%, which is annually. Gross profit margin is going to remain at 40%. Depreciation is going to remain at 1.8% of the overall sales, and I'm going to assume this is the gross sales. And the general admin expenses can be maintained at prior year's level of $3.7 million for at least 2 years. Working capital equal to 10% of the revenue. Capital expenditures are expected to equal projected depreciation expense to support the current operations plus 5% of incremental revenues to support future growth. All right. So then you have the question of do all views reported earnings? So I'm sure this slide was taken from one of the longer questions, and was one part of it. So let's just assume that Duval is the analyst, and anyway, the question asks whether they use reported earnings or normalized earnings in estimating FCFF for able. So here, normalized earnings should be used. Why? Normalized earnings would provide a more accurate representation of the company's sustainable earnings by removing the non-recurring, non-economic or unusual items. The exact definition of the normalized earnings which you have just discussed. So this adjustment would ensure that the earnings reflect the ongoing operations of the firm, making the FCFF calculation more reliable to be used as the valuation. And then you have the forecast FCFF for the upcoming year from the perspective of a knowledgeable buyer. The question asks us to do that. So let's do it, and let's do it as follows. So hope you would follow with me in this example. Let's see what's it going to be. So we are going to calculate the or rather the forecast FCFF for this company using these data for the upcoming year from the perspective of a knowledgeable buyer, and we are going to start off with the revenue calculation for the upcoming year. So step 1, calculate revenue for upcoming year. So that's going to be assigning the current revenue. Let's assign it as R. So revenue next year is going to be, let's quickly jump into the growth rate of the revenue, which is 3%. So that is going to be R into 1 plus 0.03. And then you are going to calculate the gross profit. Gross profit. So gross profit is going to be what? Gross profit is going to be 40%. It is going to remain at 40% of the sales, or rather the revenue. So it is going to be, I will name it as GP, revenue next year, into 0.4. Then depreciation, it is going to be what? 1.8% of all the sales. So it is also going to be, I will name it as DP, and it is going to be revenue next year into 0.018. And now we are going to calculate the operating income. So operating income is going to be gross profit minus general admin expenses minus depreciation. I think that is a fairly easier one to understand. And now I'm going to calculate the after tax operating income. So I will simply state it. What is the operating income is going to be? We all know it. Again, I will remind, operating income equals to gross profit minus general admin expenses, sales and general admin expense minus depreciation. And now I'm going to calculate the after tax operating income. So I'm using all these steps in order to come into the free cash flow to the firm for this company. So this is going to be, I will name this as OI. So this is going to be OI, or rather the operating income, into 1 minus T being the tax rate. So now we have come up so far. So let's recap. We calculate the revenue for the upcoming year. So current year's revenue is R, and the next year's revenue is going to be R into 1 plus 0.03. That is the expected growth rate of the revenue. Then the gross profit is going to be 40% of the revenue. We calculated GP. Then the depreciation is going to be 0.018, or rather the 1.8% of the sales. We calculated that. Then you have the operating income, which is going to be the uh, going to be calculated from gross profit minus sales and admin expenses minus depreciation. And finally, we come into the operating income after tax, which is operating income into 1 minus T. And now we are going to conduct the remaining steps. First one is the calculating the changes in the working capital. So I will remove the calculation so far. So changes in working capital, step F. Changes in working capital. So the changes delta WC is going to equal into what? 10% of the revenue, right? So it is going to be rev, I will name it as rev next year, into 0.4. Sorry, it's 0.1, right? 10%, right? So 0.1 minus current year's revenue, that is R, into 0.1, right? And then I'm going to calculate the capital expenditure, the one final step we need before coming into the free cash flow to the firm. Capital expenditure, and that would be DP, depreciation, plus the incremental revenue, which is what? Which is going to be 5% incremental revenue, right? So it is going to be 0.05, right? I will name this as CI2, sorry, CE, right? CE. And then the free cash flow to the firm is going to be after tax operating income plus depreciation minus working capital minus capital expenditure. So I'm not going to bother with the values, but just make sure you understand the different steps that we have carried out to come in this particular state. So using these steps, we can estimate the free cash flow to the firm for able company, which would provide a basis for their valuation. So this comprehensive approach would ensure that the cash flows projections are grounded in realistic and normalized financial data, accounting for the firm's operational needs and growth prospects. So to recap, we started from the calculation of the revenue for the upcoming year. Then we calculated the gross profit, depreciation, operating income, after-tax operating income, changes in working capital, capital expenditure calculation, and finally coming into the free cash flow to the firm. All right, now I will remove these sections. Okay, right. Now, income approach methods of private company valuation. So, income approach, we have uh, briefly went through this. So, it is a valuation method which is widely used for private companies, and it would actually focus on the present value of expected future income streams, and it includes three primary methods. So, what are they? First one is free cash flow method, then the capitalized cash flow method, and the residual income method. So all these three methods are familiar to you, but let's have a quick recap on this in the subsequent sections. So each of these methods rely on accurately estimating future cash flows and appropriate discount rate. So let's delve into each component and the challenges associated with determining the discount rate. First one is the free cash flow, the discounted cash flow method. So you all know this. This is the method involving projecting future cash flows of the company and discounting them back to the present value using an appropriate discount rate. So what you are going to do is project the company's free cash flow over a forecast period. Then you are going to determine the terminal value representing the company's value beyond the forecast period. And then finally discount these cash flows and terminal value to present value using a discount rate that reflects the company's risk profile. So this is commonly used for companies with stable and predictable cash flows, and it is the preferred method for many financial analysts due to its comprehensive approach. So we all know about it. We all have practiced this multiple times. It is quite vastly used method, and the explanation itself speaks out. And then you have the capitalized cash flow method. So what this would do is it would capitalize as a single period's cash flow, which is often normalized earnings or cash flow, by dividing it by a capitalization rate. So the capitalization rate is essentially the discount rate minus the expected growth rate. So the overall process going to be you determine the representative level of normalized cash flow, and then you estimate a capitalization rate based on the required rate of return and growth expectations, basically R minus G, and then calculates the company's value by dividing the normalized cash flow by the capitalization rate. So this can be applied and it is quite suitable for companies with stable earnings and growth rates, and often used when long-term forecasts are not available or not quite practical. So in a way, if you are going to value, for example, let's consider the construction firm which was quickly inaugurated or initiated prior the 2022 Qatar World Cup. A lot of construction firms were involved, but there were few who were specifically initiated in order to handle the overall construction of the football stadiums distinctively, rather than focusing their efforts on other construction projects. So for a firm like that, they can use this method because their long-term forecasts are not particularly available, because the entire purpose of these entities was to establish them until the overall construction of the stadiums and the associated facilities were completed. So once that is done, these companies are no longer needed. So they would ideally freeze their operations, or ideally they would be absorbed back into their mother companies. So for those type of companies, which are basically private entities, the capitalization cash flow method would be the most ideal one to be used. And then you have the residual income or the excess earnings. We have covered this explicitly in our previous session. So to give you a brief explanation, this would calculate the value of the company by adding the percent value of residual income, which is the income after accounting for the cost of capital, to the book value of net assets. So here you would calculate the residual income for each forecast period. You discount the residual income back to the present value, and then you add the discounted residual income to the book value of net assets to determine the total value. So, what are the challenges uh, in all of these methods associated with the discount rate? Because in free cash flow method, discount rate is applied because you discount the free cash flow back to the present value. In capitalized cash flow method also, you are going to use the capitalization rate, which is the discount rate minus growth rate. So discount rate is again going to be used. And then in the residual income also, you are going to discount the residual income to the present value. So in every method, you are going to use the uh, discount uh, discount rate, but you are going to be accompanied with certain level of issues with the uh, utilization of the discount rate. So, what are the challenges in estimating the discount rate? First one would be application of size premiums. So just to give you a quick recap of the overall discount rate estimation issue, estimating an appropriate discount rate is going to be quite challenging, because it should reflect the risk profile of the company and the expected return of the investors in an accurate manner. So for all of our questions, all the practice problems, it is easiest to say that R equals this amount, R equals this amount, or that amount. It is quite easier to say, but in actuality, if you're going to apply those into actual business valuations, which would have real consequences, then this is going to be quite a problem. So let's go over some of the challenges and some of the methods which we usually use in order to uh, come into estimating the overall uh, uh, discount rate calculation. So first one is going to be the application of the size premiums. So small companies typically carry high risk compared to larger companies. So this can be reflected in the discount rate by adding a size premium uh, associated with the company's overall size. And then using the CAPM model, capital asset pricing model. So this is commonly used to estimate the discount rate by considering the risk-free rate, beta or the beta measure of the systematic risk, and the equity risk premium. Then you can use the expanded version of the CAPM model. So this version of the CAPM includes additional risk factors such as size and industry-specific risk factors. So if it is oil and gas, you can add oil and gas specific risk factors. If it is chemical, you can add chemical industry specific risk factors, things like that. And then you have elements of the build-up approach. So this approach builds the discount rate by adding various risk premiums to the risk-free rate, including the equity risk premium, size premium, and company-specific risk premium. And then you have relative debt availability of and cost of debt. So the company's capital structure and the cost of debt influence the overall discount rate, particularly in a weighted average cost of capital calculation. And then you have discount rates in an acquisition context. So in acquisitions, discount rate may need to reflect the buyer's cost of capital or the specific risks associated with integrating the acquired company. And finally, we have discount rate adjustment for projection risk. So higher uncertainty in cash flow projections requires a higher discount rate to compensate for the increased risk. And then we are going to focus on the free cash flow and capitalized cash flow method and excess earning method, which we have just discussed right here. So I have already provided you enough of an explanation here, but here you have some additional information too. And here you have some additional information regarding the discount rate calculation too. So read this in your free time, and it will provide you some additional information to the different uh, uh, methods of valuation calculation under the income approach method, and also the imperativeness of discount rate and how it is being calculated under distinct circumstances. And here we come into the market approach methods. All right. So under the market approach method, what's the difference going to be compared to the market approach method and the income approach? So, market approach to valuation is based on comparing the subject company to similar companies or transactions in the market. So, here I'm going to detail the primary methods used in the market approach, highlighting the applicability and nuances in valuing private entities. So, valuation multiples. So, I'm sure you have discussed this or you have went through this in Professor Damodaran lectures also. So valuation multiples can be addressed in different aspects. First one is the public firms versus private firms. So public firms are often valued using the price to earnings ratio, PE ratio. So for large private firms, valuation is typically based on the EBIT, or the earnings before interest and tax, or EBITDA, earnings before interest, taxes, depreciation, and amortization multiples. And then you have market value of invested capital, MVIC. So MVIC is a metric which is used as a numerator in multiples, representing the total value of equity and debt. So here the equity value can be derived by subtracting the market value of debt from the MVIC. And then you have multiples for different firm sizes. Small private firms with limited assets may use net income multiples. So, on the contrary, extremely small firms might use revenue multiples due to the impact of discretionary expenses like owner compensation. And then you have these different aspects under the utilization of valuation multiples. And here we are going to focus on three additional method which can be used, or which is used under the market approach method, which are the guideline public company method, GPCM, and guideline transaction method, GTM, and prior transaction method, PTM. So let's start off with the guideline public company method. So, guideline public company method is a market approach used in business valuation, which involves comparing the subject private company to similar publicly traded companies. So, I will focus on incorporating control premiums when evaluating a controlling equity interest in a private firm here. So, control premium. Control premium is the additional value an investor is willing to pay over the market price of a non-controlling or a minority interest to acquire a controlling interest in a company. Again, let's understand this thoroughly. It is the additional value investors is willing to pay over the market price of a minority interest to ultimately acquire the controlling interest in a company. So, owning a controlling interest in would provide the power to influence or direct the company's management and policies, which is valued higher than the non-controlling interest. So, that additional amount you are willing to pay to acquire this is, explained by control premium. And what would influence the control premium? So you have these are listed right here. So I will go through them one by one. First, you have the transaction type. And here, you need to focus on the strategic versus financial transactions. So, strategic acquisitions where the buyer aims to achieve synergies often command higher premiums than financial or non-strategic transaction. So, for example, a technology company acquiring another tech firm to integrate technologies might pay a higher premium than a private equity firm making a purely financial investment, because the technology you are going to achieve with this synergy with the acquisition and merger, the synergy you are going to generate is much higher than a standard financial transaction. Then you have industry conditions. So Here, acquisition activity is going to be focused on, which is the high acquisition activity would drive up acquisition prices and control premiums. So, in a tech boom, for example, high acquisition activity would lead to inflated control premiums due to the competitive biddings by various parties. And then you have type of consideration, and here you need to consider stock or cash. So acquisition involving the acquired stock rather than the cash may affect control premium estimates. So stock deals might be influenced by the current market valuation of the company's shares, while cash is essentially going to be the cash value of the company. So if a high growth tech company uses its overvalued stock to acquire another firm, the control premium might be overstated because its current value is going to be based on its stock and it is in an overvalued state. And then you have the reasonableness. So the reasonableness control premiums based on historical acquisition data must be reasonable and not reflect temporary or bubble values. So, for example, a control premium derived from acquisitions during a market bubble might not be applicable for normal market conditions. Exactly, a precise example would be the bubble dot com bubble in the 90s. So if you were going to value a tech firm in the 90s when the dot com bubble was in its pure stringence, then that valuation would not be accompanied if you're going to value the same company today if it even exists. So you need to adopt into a completely different valuation approach if you're going to value the company which was valued during the dot com bubble if you're going to value it today. All right, so uh, we are going to now discuss the different methods for incorporating the control premium. So we have the raw multiple method first. The process here would be you are going to estimate the firm value using raw multiples such as the EBITDA multiple or the EBIT multiple without including the control premium. And then you are going to subtract the firm's debt to determine the equity portion. And finally, you are going to apply the control premium to the equity portion to adjust the value. So this sound quite complex, but let's try to address this through an example. So, for example, if the estimated firm value using EBITDA multiple is 50 million, all right? So the firm value is estimated using EBITDA, earnings before interest, tax, depreciation, and amortization, and that the value is 50 million, and the firm has 10 million in debt, and equity is 40 million. So if you would apply a 20% of control premium due to any number of reasons which we have discussed earlier, the adjusted equity value becomes 48 million because 40 million into 20%, right? Actually, 40 million into 1.2%, that would accurately represent the equity. And then you have the adjusted control premium for MBIC multiple. So here we start with an equity control premium, and then you are going to adjust the control premium for MBIC using the formula of control premium on equity into 1 minus dr. All right. So let's take a practical example. So dr here is the debt to asset ratio. So let's take an example to make this more sense. All right. So let's say you have a private company. You have a private company estimated value of $100 million. All right. You have a private company with an estimated firm value of $100 million. So this was achieved using EBITDA multiple. So under the market approach, you are going to use income multiples, and the multiple which was used to value this company at 100 million was EBITDA multiple. Then company has 20 million in debt. The equity control premium is, or the additional amount you are willing to pay to acquire a controlling interest of this firm is 20% to the original share. So if you would use the row multiple method, if you would use the row multiple method here, firm value is 100 million. Equity value is going to be 100 minus 20. So I will just simply state it. Equity is going to be 100 minus 20. It is going to be 80 million. And the control adjusted equity value, which is quite simple, 80 into 80 million rather into 1 plus 0.2, which is basically 8 into 12, 9.6, 96 million, right? So this is going to be the equity, control adjusted equity value, right? 96 million. So what we have just did is we identified the firm value, which is estimated using the EBITDA multiple. The equity control premium is 20% and the debt value is 20 million. So based on that, we identify the equity to be 80 million and the control adjusted equity value is going to be 96 million, where 80 million is multiplied by 1.2, which is the control premium. So now we will use the adjusted control premium for MVIC. So I will remove up until this. So here we need to calculate the debt to asset ratio, DR ratio, which is going to be basically 20, right? 20%. And the adjusted control premium here is going to be equity control premium. So I will write it out for your understanding. Adjusted control premium, it is going to be 20% minus 1, sorry, 20 into 1 minus dr, 20 into 1 minus 0.2, which is 20% into 0.8, 4/5 of 20, that's going to be 16. So adjusted control premium is going to be 16, and control adjusted firm value, control adjusted firm value is going to be, the overall firm value is 100 million into 1 plus 16%. That's basically is going to be 100 million into 1.16, that is 116 million. 116 million. So let's just focus on what we have discussed so far. So we started off with the uh, market approach, and under the market approach we have identified that income multiples are going to be used, and there under the market approach we are started with the guideline public method. So here the method would value the company based on valuation of multiples of comparable public companies when it comes to the valuation of the private entity. So here we started with focusing on the control premium concept, where the additional amount one would willing to pay over the market price of the non-controlling interest to acquire a control interest. And under that we identify how to incorporate the control premium, and under two methods we can do that. First one is the row multiple method. So under the row multiple method, what we would do is we estimate the firm value, we subtract the firm's debt to understand the equity, and then the control premium is applied to the equity to adjust the value. So that's how we got 96 million earlier as the firm value. And then you have the adjusted control premium for MVIC. So here the adjusted control premium is calculated via control premium into 1 minus debt to company ratio, DR ratio. And here in this example, we did exactly that. We identified the firm value, estimated firm value by the EBITDA multiple. We identified the debt to equity ratio, which is 20%. And then we have calculated the adjusted control premium, which is 16%. So now you can see with the incorporation of the debt ratio, it has reduced from 20% to 16%. And finally, using this adjusted control premium, we have calculated the control adjusted firm value, which is 116 million. So you can see based on the approach you are going to take under the guideline public method, the final control adjusted firm value is going to differ. So hope you had a substantial understanding about that, and I encourage you to read more on this, try your own examples and see how numerically this is going to be worked out. All right. And now we come into the guideline transaction method. So the guideline transaction method is again a market approach used to value private companies by referencing historical transactions involving the sale of similar firms. So this method is particularly useful when data on public companies is not sufficient or relevant. However, it requires a careful consideration of several issues due to the limited and sometimes inaccurate data available on private firm transactions. So we already know that the available amount of data is going to be limited when it comes to private companies. So when you are going to apply the guideline transaction method as a market approach to value a private company, you need to understand these challenges and then process accordingly. So the challenges with the data availability uh, when it comes to the private companies. So in contrary, the data on public company sales are readily available and offer reliable, while private firm transaction data is less accessible and may lack accuracy. So in the same time, due to the higher risk associated with private firms compared to public firms, appropriate adjustments must be made to the multiples derived from public company data. So you do the multiple into similar scale public firms when you're going to value your private company. These factors need to be thoroughly reminded and thoroughly remained throughout the entire valuation process. So the process of guideline transaction method, first you need to identify comparable transactions. So the first step involves finding historical transactions of companies similar to the company you are going to analyze. Then these transactions should be within the same industry and have similar financial metrics such as EBITDA, revenue, or growth prospects. I think we actually have this example right here, so it would be easier if we can simply adopt this example to analyze the guideline transaction method. So it says that Natalie Hoskins is valuing a private firm, Lafayette Furniture, for acquisition using the guideline transaction method and MBIC to EBITDA multiples. Hoskins deflates the average public company multiple by 30% to account for the higher risk of Lafayette. Other data are market value of the debt is 1.4 million, normalized EBITDA is 18.2 million, average MVIC to EBITDA multiple is 7.2. So first step is to identify comparable transactions. So here you need to find historical transactions of companies similar to Lafayette Furniture. So basically, you need to identify a publicly traded company in the furniture industry, let's say IKEA. So identify transactions of a company like IKEA first, then these transactions again should be within the same industry. So we are good there if we were to select IKEA and have similar financial metrics such as EBITDA, revenue, and growth prospects. So if the Lafayette is uh, at least a country scale furniture business, then it would be ideal and it would make sense to select a company like IKEA to uh, perform with the historical transactions in order to perform the guideline transaction method. Then you need to adjust multiples for risk. So given that private companies typically carry higher risk than public companies, it is crucial to adjust the valuation multiples to reflect this increased risk. Natalie Hoskins deflates the average MVIC EBITDA multiple by 30%, right? So it says that. So this deflation accounts for factors such as less liquidity, high operational risk, and potential differences in management quality. And then third one would be apply the adjusted multiples. So the adjusted multiple is then should be applied to the normalized EBITDA of Lafayette Furniture to estimate the MVIC. So it is this is going to be the adjusted multiple is going to be uh, 30% deflation from the calculated multiple. So 7.2, you need to multiply 7.2 into 30% and then subtract that amount from 7.2. So let me quickly do that. 7.2 into 0.3. Let's see. 7.2 into 0.3, and then that is 0.216, and then 7.2 minus 0.216 is going to be 6.984. Uh, right. That would be done. And then finally calculate the MVIC and the equity value. So by multiplying the normalized EBITDA by the adjusted multiple, we come into the MVIC. So this would represent the total value of the company's equity and debt. So subtracting the market value of debt from MVIC would give us the equity value, providing a clear estimate of what the equity in Lafayette Furniture is worth. Right. Now, I think we have a clear idea on the equity calculation. So let's apply these into the overall calculation. So we start off with the market value of debt. So Lafayette Industries. So MV of debt 1.4 mil. Normalized EBITDA is 18.2. 18.2. The average MVIC EBITDA multiple is 7.2. All right. So now we are going to uh, conduct the evaluation with these steps that we have identified. So the first one is to uh, identify comparable transactions. So let's assume we have already done that. And then we are going to calculate the adjusted MVIC, right? Adjusted MVIC EBITDA. So how we are going to do is deflation factor is presented to be 30% to account for the higher risk of Lafayette, which is a private company. So what we are going to do is not actually 7.2 minus 0.3%, it is actually 7 point into 1 minus 0.3. Sorry about that. So it's going to be 7.2 into 0.7 right here, which is, I believe, 72 into 7, 504, then 5.04, right? So now we are going to calculate the MVIC, right? Market value of invested capital. So we have the normalized EBITDA 18.2. We have the adjusted MVIC. So what we are going to basically do is 18.2 mil into 5.04, which is 91 million 7.28, right? So we have calculated the market value of invested capital. So we have the market value of invested capital to be 91 million point 72. We have the market value of debt to be 1.4. So equity is basically going to be 91.7 million. So equity is going to be 9172 minus 1.4 million. It is roughly 90.32 million, the equity value. So you can see, although it seems quite complex, the overall application is going to be somewhat easier. So in the Lafayette, we first calculated the adjusted MVIC, but of course, before that, you need to understand the historical transactions of companies similar to Lafayette. But let's assume that that has already been done. Then we adjust the MVIC with the deflation factor, incorporate the deflation factor into this, and then we calculate the market value of the invested capital, and then from that we derive into the equity value. So guideline transaction method is a powerful tool, you can see. So with a small number of steps, or rather small amount of effort, we have come into a conclusive figure of estimating the overall market value of invested capital of this private entity, as well as the overall equity value. So it is a quite powerful tool for valuing private companies by leveraging historical transactions data. However, you need to remember that due to the inherent risks and data limitations associated with private firms, careful adjustments are necessary in order to ensure accuracy when you are going to value the equity or the market value of invested capital of a private firm under the guideline transaction method. So, by applying appropriate deflation factors and using relevant comparable transactions, analysts can derive a realistic valuation that would reflect the true market value of the private firm. So you can see this method is particularly effective when reliable data on public companies is insufficient, offering a practical alternative for private firm valuation. So we have conducted a detailed discussion on the guideline transaction method and the guideline public method. So the final method under the market approach method is going to be the prior transaction method. So, prior transaction method is a market-based approach used in business valuations relying on historical transactions involving the stock of the actual subject company. So, this is particularly useful for valuing minority or non-controlling interests because you are going to see the data sources and the basis of valuation and the transaction characteristics are ideally suited for the valuation of minority interests. So, uh, the source of data is going to be the data from a stock of the actual subject company, and it would provide a direct market indication of the company's value based on real historical transactions. And the basis of the valuation would be the actual transaction price or multiples derived from similar transactions. So if the previous transactions were at arm's length, they would provide a reliable basis for valuation. So the transaction prices or the derived valuation multiples can be directly applied to the current valuation exercise under the prior transaction method. So in order to perform the prior transaction method, the below are the ideal transaction characteristics. So first we have the arm's length transactions. So transactions should ideally be arm's length. We all know the fair value derived with the basis of the occurrence of an arm's length transaction. So this would mean that the transaction would occur between willing buyers and sellers and acting in their self-interest and not under duress. So the motivation which would be ideal to perform the prior transaction method is previous transaction should have the same motivation, strategic or financial, as the subject transaction. So, for example, if the previous transaction was strategic, for instance, acquiring shares to gain a strategic advantage, it should be comparable to the current valuation context. And also, since we are going to use previous historical transaction, recency should play a crucial role. So, transactions should be fairly recent to ensure that they reflect the current market conditions and economic environment. So, if you are going to value a private company using prior transaction methods, that means you are going to use historical transactions, and if you are doing the valuation in 2024, it would not make sense to use transaction that was occurred in 1999 or 2000 because that's 2 decades, right? So it's not going to reflect the current market conditions and economic circumstances. So In this case, you need to make sure that these aspects are considered, and based on that, you will be able to come into a more conclusive uh, result under the prior transaction method. All right, so let's consider a quick example to this, similar as the other two methods also. So let's say that XYZ Corporation has the multiple stock transactions in the past year, and let's assume that these transactions had occurred at arm's length, involving minority interest and motivated by financial investment. So transaction data as follows. So transaction 1, 5,000 shares sold at $50 per share. Second one, 3,000 shares were sold at, uh, sorry, not 32, $52 per share. 3, 2,000 shares were sold at $51 per share. So what's going to be the average transaction price if you are going to base your valuation on these three prior transactions? So your average price is going to be, this is quite easy, but I will quickly show you the steps. 5,000 into 50 plus 3,000 into 52 plus 2,000 into 51 divided by number of shares, 5,000, 3,000, 2,000, and this should be closer to, somewhat closer to 50. Let's quickly do the math. Yeah, $50.08 per share, right? So that's going to be the average price if you're going to base this historical transaction. So if you're going to do the valuation using the prior transaction method, let's assume that the total shares outstanding is going to be 100,000. So shares outstanding is 100,000. So the equity value is going to be 100,000 into 50.8 per share, which is $5,080,000. So you can see you have conducted the equity valuation using the prior transactions which had occurred, and then based on that you have come into an average share price, and then you have estimated the overall equity value of the XYZ company. So this is a very fairly easier and a quite simple instance where only three prior transactions are used, but theoretically you can include many number of prior transactions provided that they are adopted into the uh, they are adopted into the overall uh, aspect of the uh, different characteristics that we have just discussed, being an arm's length transaction, having the proper motivation, and the having the proper recency. Right. Then we come into asset-based approach. So asset-based approach is a valuation method that determines a company's value by calculating the fair value of its assets and subtracting the fair value of its liabilities. So this approach is generally less common for valuing going concerns and is more suited to specific types of companies and situations. So here the key idea here is that company's value can be determined by the net value of its assets after all liabilities have been settled. So it would focus us on the balance sheet rather than the future earnings or cash flows. Right. Now, valuation discounts and premiums. So valuation discounts and premiums adjust a company's value to reflect factors affecting its marketability and control. So here we are going to focus on two main types of discounts and their calculation methods. Discount for lack of control, DLOC, and discount for lack of marketability, DLOM. So discount for lack of control, DLOC, this is applied when valuing minority interests that do not have control over corporate decisions, such as selecting directors or settling management compensation. Minority shareholders have less power to influence corporate policies and decisions, making their shares less valuable compared to controlling interests. So, what factors would affect the DLOC? First one is going to be the control premium. So the control premium paid for acquiring a controlling interest in a company. Here the DLOC is going to be inversely related to the control premium. Then you have the compensation and prerequisites. Controlling shareholders might enjoy benefits not available to minority shareholders, potentially harming the latter's value. Minority shareholders value, that being said. Then the initial public offering or sale of shares. So companies preparing for an IPO or an sale might be less likely to engage in actions detrimental to minority shareholders, affecting the DLOC. And then we come into the discount for lack of marketability. So DLOM is applied when an interest in a firm cannot be easily sold, reflecting the liquidity of the shares. So shares that are not readily marketable are less attractive to investors, hence lowering their value. So similar to DLOC, what factors are going to impact the DLOM? First one is going to be the impending IPO or sale. So it would decrease DLOM as the shares will soon become liquid, because if you are in front of an IPO, uh, you would know that your shares are going to be soon uh, bought by the public. Then uh, this would essentially, lack of marketability is going to be decreased because initial public offering is nearby. Then payment of dividends. This is also going to decrease DLOM as it would provide liquidity through regular income. And then short restriction periods, again, that's going to decrease DLOM. Contractual restrictions increase DLOM due to limitations on selling stocks, because when you imply or impose restrictions on working with the existing number of shares, that would increase the lack of marketability, because you are going to sell the stock, it is not going to be an easy task, right? And then you have market demand. Greater buyer interest decreases DLOM, because the lack of marketability is going to be decreased when a lot of people are interested in your shares. Then the risk, and when you have higher risk, people do not tend to buy your shares. That means it is going to also increase the DLOM. So the uh, calculation methods in order to calculate the discount of lack of marketability is, you can have a price comparison where the prices of pre-IPO shares to post-IPO shares. Then you have restricted shares, so value in shares that cannot be sold immediately. Then you have put option pricing. So you would learn more on this in your seventh semester, I would believe. We are using a price of a put option divided by the stock price, assuming the option is at the money. So just don't uh, think too much on the option pricing, which is used to hedge the risk and used as alternative investment instruments. You will learn a lot more on this functionality in your upcoming seventh semester. But having said that, here the total discount calculation is going to be 1 minus DLOC into 1 minus DLOM, right? So here you have a question. Uh, it says that the minority shareholder holds 15% of the private firm's equity, CEO holds the 85%. Two scenarios can be applied. First one is CEO will likely sell the firm quite soon. In this case, the valuation discount will be quite small. DLOM of 5% will be applied, and a DLOC will not be applied under the assumption that all selling shareholders will receive the same price. Value of the firm's equity is 10 million. In the scenario 2, CEO is not going to sell the firm. He has no plans to do that. Minority shareholders cannot sell its interest easily. DLOM of 20% now is applied. You can see, because the selling of the shares is not going to be quite easier. And in this case, DLOC is going to be estimated by using reported earnings instead of normalized earnings to provide an estimated firm equity value of 9 million. So using these figures, we are asked to calculate the value of the minority shareholders' equity interest under the both scenarios. So here, firm equity value is 10 million under scenario 1. Minority shareholder percentage is stated as 15%. So basically, the equity value before discounts going to be 10 million into 0.15, which is 1.5 million. And if you would apply the DLOM of 5% to this, that would be 1.5 million into 1 minus 1.5, which is the 1 plus 5%, that's going to be 1.5 million into 0.95, that is $1.425 million. So under the scenario 1, given the CEO's imminent plan to sell the firm, minority shareholder can expect to receive a price similar to the controlling interest, leading to minimal discounts. So the small amount of discount, lack of marketability 5%, would reflect the firm's upcoming liquidity because the CEO is obviously going to sell the firm, so more money is going to flow soon. So this would reduce the equity value slightly. Since uh, no DLOC is going to be applied, the primary adjustment is through the DLOM, which results in the final equity value of $1.425 million for the minority shareholder, which would slightly reduce the current equity value of the minority shareholders. Then scenario 2. So in this case, firm's equity value is going to be 9 million, and still before discounts the uh, equity value of associated to the minority shareholders is going to be 9 million into 15% of the minority shareholder percentage. That's going to be 1.9 into 15, 1.35. And then if you would apply the DLOM of 20% in this case, because in this case CEO has no plans to sell the firm at all. So in that case, 1.35 million into 1 minus 0.2, which is basically 1.35 million into zero point 0.8, that's going to be 1 million and 80,000. So that is the equity value after the DLOM. And equity value after the DLOC is now 10% of DLOC is going to be estimated. So here the equity value after the DLOC is going to be 1 point, or rather 1,080,000 multiplied by 1 minus zero point 0.1 or 1 minus 10%, that would be $972,000. So in this scenario, the absence of a sale and the inability to minority shareholder to sell their interest easily result in higher discounts, which is evident by the DLOM of 20%. So this would account for the liquidity and difficulty in selling the shares. And in addition to that, the DLOC of 10% would reflect the reduced value due to the lack of control of the firm's decisions. So these combined discounts significantly lower the equity value to 972,000 for the minority shareholder, emphasizing the impact of marketability and control on valuation. So this question itself would illustrate how DLOC and DLOM significantly affect the valuation of minority interest in a private firm. So in scenario 1, where the CEO is going to sell the firm, it demonstrates a situation with minimal discounts due to the impending liquidity because of the expected sale of the company, while scenario 2 shows substantial discounts reflecting both control and marketability issues. So the first one had only had marketability issues of 5% because you are going to anyway sell the firm soon, but in the second scenario, the firm is no longer is going to be sold. The CEO has no plans to sell the company. So in that case, you can see how both control and marketability were incorporated with a DLOM of 20% and a DLOC of 10%. So in that case, by understanding and applying these concepts, analysts can more accurately assess the value of minority interest considering the specific circumstances and limitations involved. And finally, we come into business valuation standards and practices. So, valuation standards are essential for ensuring the accuracy, reliability, and transparency of business valuations. We have covered some of this before also. So, these standards would protect users of valuations by providing consistent methodologies and practices. So, I'm going to highlight the key organizations and their respective standards that govern business valuation practices. First of all, we have the International Valuation Standards, so IVS. So, IVS is a set of international standards aimed at harmonizing valuation practices across different countries. So, the standards are periodically updated to reflect changes in the market and advances in valuation methodologies. The widespread adoption of IFS by various countries and valuation institutions underscores its importance in providing a common language and framework for valuers globally. So, in global sense, you can see IVS and its currently set up rules and guidelines would be quite crucial. And then you have the Statement on Standards for Valuation Services, SSVS. So this was developed by the AICPA to guide the CPAs or Certified Public Accountants in delivering consistent and high quality valuation services, and these are particularly relevant in United States. So the members of the AICPA or the Certified Public Accountants are required to comply with the SSVS standards, ensuring that their valuation practices meet professional quality. And this would include providing clear documentation, using appropriate valuation methods, and maintaining objectivity. And finally, we have International Private Equity and Venture Capital Valuation Board, IPEV board. So the IPEV board provides guidelines specifically for valuing private equity and venture capital investments, where these guidelines are crucial for fund managers, investors, and auditors involved in the private equity and venture capital industry. So the primary objective of even having a institution like an IPEV board is uh, the guidelines of IPEV board specifically aims to ensure that valuations of private equity and venture capital investments reflect their fair value. So rather than the institutions prior to this IBAS or SVSS, here in the IPEV board, their guidelines want to ensure that the fair value is secured when it comes to the valuation of private equity and venture capitals. So this involves considering market conditions, the financial performance of portfolio companies, and other relevant factors. So by providing a standardized approach, the IPEV guidelines would help enhance the credibility and comparability of valuations within the private equity and venture capital sector. So in an overall sense, valuation standards obviously would play a critical role in ensuring the integrity and reliability of business valuations. So the institutions that we have discussed, IBS, SSVS, and IPEV, their guidelines, each of their guidelines would contribute to a structured and consistent approach to overall valuation, creating to different aspects of the valuation landscape. So adhering to these standards would help protect the interest of stakeholders, provide transparency also, and promotes confidence in the overall valuation process. So, as the field of business valuation continues to evolve, these standards will remain pivotal in guiding best practices and maintaining high professional standards across the industry. So, here we come to the end of the private income, private company valuation. So, you can see we covered a lot of theory here. Some of things might seem quite complicated and complex, but just focus on the explanations and examples I stated during this lecture, and using that thought process, I think you would be able to easily understand the theoretical aspects behind the private income calculation. So I would particularly encourage you to focus on the earnings normalization and cash flow issues, which could be a part that could be tested in your final examination. So if you would follow the examples that I have provided to you, then I'm sure you will be able to achieve a good grade for the questions which comes under the private income valuation. So that would be it for this session. We'll meet next with the final session of your business valuation and analysis class, which is the mergers and acquisitions. So until then, have a great day and goodbye.